The United States just locked in Taiwan with a $250 billion handshake. Tariffs slashed to 15%. $250 billion in chip factories moving to American soil. And China is watching every move. This is not a trade deal. This is economic warfare. And if you're not paying attention, you're going to miss the most important realignment of global power in a generation. Let's break it down. Welcome to Economic Warfare. I'm your host, and today we're covering a story that just broke, but will define the next decade of technology, money, and geopolitical power. The United States and Taiwan have finalized a massive trade agreement that fundamentally reshapes the global semiconductor industry. And here's what you need to understand by the end of this video. What exactly this deal does. Why it's far more than just a trade agreement. Because this is day one of a very long chess match, let's get into it. Here's what happened. As of today, January 15th, 2026, the United States and Taiwan reached a comprehensive trade deal focused on semiconductors and advanced manufacturing. This isn't rumor or speculation. This comes from official fact sheets released by the U.S. Commerce Department, reporting from Reuters, Bloomberg, the New York Times, BBC, and multiple other major outlets. The core of the deal is simple but profound. The U.S. is cutting tariffs on Taiwanese imports to around 15%, roughly aligning Taiwan with the same preferential treatment given to close allies like Japan and South Korea. In exchange, Taiwan, led by its powerhouse chip companies, has pledged at least $250 billion in investment in American semiconductor manufacturing over the coming years. That includes massive expansions of Taiwan Semiconductor Manufacturing Company, TSMC, fabrication plants on U.S. soil, along with related supply chain infrastructure. The Taiwanese government is backing this with credit guarantees and financial support to make sure the money flows. This is officially framed as restoring American semiconductor leadership and securing critical supply chains. But if you think this is just about making computer chips cheaper, you're missing the entire story. Let me explain this deal in plain English. Right now, semiconductors are the new oil. They power everything. Your phone, your car, AI systems, military drones, data centers, the entire digital economy. And for decades, the world's most advanced chips have been made in one place, Taiwan. Specifically by TSMC, which manufactures over 90% of the world's cutting-edge semiconductors. That's a massive strategic vulnerability for the United States. If anything happens to Taiwan, whether it's a Chinese invasion, a natural disaster, or political instability, the entire American economy grinds to a halt. No chips means no iPhones, no cloud computing, no AI development, no military systems, nothing. The U.S. government has known this for years, and they've been working to fix it. That's where this deal comes in. Here's what's changing. Before this agreement, Taiwanese goods entering the U.S. faced tariffs that varied widely depending on the product. Some were low, some were much higher, and there was no consistent framework. Under this new deal, tariffs on most Taiwanese imports dropped to around 15%, putting Taiwan on par with Japan and South Korea, two of America's closest allies in Asia. That's a big carrot. Lower tariffs mean Taiwanese companies can sell more competitively in the American market, which is the largest and most profitable in the world. But here's the stick, or rather, the price Taiwan is paying. In return for these tariff cuts, Taiwan is committing at least $250 billion to build semiconductor manufacturing capacity in the United States. That's not a loan, that's direct investment. Building factories, buying equipment, hiring workers, training engineers, creating entire supply chains on American soil. The centerpiece is TSMC. They're already building fabs in Arizona, but this deal accelerates and expands those plans dramatically. We're talking about multiple advanced fabrication facilities capable of producing the most cutting-edge chips in the world, the kind that power AI models, supercomputers, and next-generation smartphones. And it's not just TSMC. Other Taiwanese chip companies and suppliers are expected to follow, creating an entire ecosystem of semiconductor production in the U.S. The Taiwanese government is sweetening the pot with credit guarantees and financial backing, essentially saying to these companies, "We will cover your risk if you make this move." This connects to earlier U.S. policies like the CHIPS Act, which provides subsidies and tax breaks for domestic semiconductor manufacturing. The U.S. is essentially paying companies to relocate, and Taiwan is paying them to relocate specifically from Taiwan to America. Now let's talk about why this is advanced economic warfare. When you hear economic warfare, what does that mean? It's not tanks and missiles. It's tariffs, sanctions, subsidies, supply chain control, and technology restrictions used as weapons to achieve geopolitical goals. Think tanks and global risk analysts now rank geoeconomic confrontation, the use of economic tools for strategic purposes, as one of the top global risks. And this deal is a textbook example. This is not just about making America more competitive in semiconductors. It's about physically relocating the crown jewels of global technology into U.S. territory and out of reach of China. Let me explain the layers. Layer 1. Alliance lock-in. By giving Taiwan preferential tariff treatment and massive financial incentives, the U.S. is pulling Taiwan deeper into its economic and security orbit. Taiwan is already dependent on American military support to deter Chinese aggression. Now Taiwan's biggest companies are investing hundreds of billions in American soil, creating a financial and political bond that's almost impossible to break. If Taiwan ever considered neutrality or trying to balance between the US and China, that option just disappeared. They're locked in. Layer 2. Supply chain relocation. For decades, globalization meant building factories wherever it was cheapest and most efficient. That usually meant Asia, especially China and Taiwan. But efficiency isn't the only thing that matters anymore. Resilience and control matter too. By moving TSMC fabs to Arizona, the U.S. is ensuring that if something happens to Taiwan, whether it's a Chinese blockade, a military conflict, or even just political pressure, America still has access to advanced chips. You can't blockade Arizona. You can't invade Arizona. The factories are on U.S. soil, protected by U.S. law and U.S. military power. That's strategic depth. Layer 3. Weakening China's position. Here's the part Beijing really hates. China has been trying for years to build its own advanced semiconductor industry to reduce dependence on foreign chips. They've poured hundreds of billions into subsidies, research, and development. But they're still years behind TSMC and other leading manufacturers, and now the U.S. is ensuring that the gap stays wide. By locking TSMC capacity into the U.S. and cutting off China's access to the most advanced manufacturing equipment through export controls, America is choking China's ability to catch up. And this deal makes it worse. Every dollar TSMC invests in Arizona is a dollar they're not investing in new capacity that could serve Chinese customers. Every engineer working in an Arizona fab is an engineer who isn't available to help China close the gap. This is economic containment. And China knows it. Let me give you an analogy. Moving semiconductor fabs from Taiwan to the U.S. is like moving aircraft carriers. It's slow, expensive, and requires massive coordination. But once it's done, it changes the balance of power. Taiwan's fabs were like aircraft carriers parked just off the coast of China, vulnerable but powerful. Now, America is pulling those carriers back to home waters, out of China's reach, and building even more on U.S. soil. That's not just trade policy. That's grand strategy. So who wins and who loses from this deal? Let's break it down. Short-term winners, American semiconductor companies, Intel, Micron, Global Foundries, and the entire supply chain of equipment makers, construction firms, and material suppliers are about to see a massive wave of investment. $250 billion doesn't just build fabs, it creates jobs, stimulates regional economies, and drives innovation. Arizona is about to become a semiconductor powerhouse. TSMC and other Taiwanese chip makers also win. They get tariff relief, making their products more competitive in the U.S. market. They get subsidies from the CHIPS Act, and they get stronger political protection from the U.S. government. If China ever threatens Taiwan, America now has a direct financial stake in Taiwan's survival because American factories depend on Taiwanese expertise and continued cooperation. U.S. politicians win too. They can claim they're bringing manufacturing back to America, creating jobs, and securing critical supply chains. That's a winning message for both parties. Now, the losers. China's strategic position just got significantly worse. Every analyst and commentator is noting that Beijing will view this deal as openly anti-China. And they're right. This is designed to contain China's technological rise. Chinese policymakers are already signaling their displeasure. Smaller economies that hope to attract semiconductor investment, countries like Vietnam, Malaysia, or even India, just got outbid. They can't offer what Taiwan offers: the world's best chip technology, decades of expertise, and the geopolitical value of being a flashpoint in the US-China rivalry. Taiwan is paying what some analysts call an insurance premium. They're spending $250 billion to ensure continued US support against China. No other country can make that play. But here's where it gets interesting: medium-term risks. China is not going to sit quietly and accept this. What can they do? Several options, all escalatory. Rare earth restrictions. China controls most of the world's rare earth elements, critical materials for everything from smartphones to missiles. They could restrict exports to hurt American and Taiwanese tech companies. Regulatory harassment. Chinese regulators could suddenly find problems with Taiwanese companies operating in China, forcing audits, fines, or restrictions. Many Taiwanese firms still do significant business in mainland China. Beijing could squeeze them. Military pressure. China could increase military exercises around Taiwan, fly more fighter jets into Taiwan's air defense zone, conduct naval drills, all designed to send a message: you're picking the wrong side. Economic coercion. China could ban Chinese companies from buying Taiwanese chips or using Taiwanese suppliers, trying to force Taiwan to choose between the US market and the Chinese market. None of these are confirmed yet, but every expert is saying, watch for retaliation. This deal just raised the temperature in the tech war. Let's talk markets. How did investors react? Initially, positive. Stocks of semiconductor equipment companies, construction firms with exposure to Arizona, and U.S. chip manufacturers all ticked up. Why? Because $250 billion in investment is real money. It means years of contracts, revenue visibility, and economic growth. TSMC's stock held steady because the deal gives them political cover and tariff relief, even though they're committing huge capital. But here's what investors are missing or choosing to ignore for now: geopolitical risk is rising, not falling. Yes, this deal makes U.S. supply chains more resilient, but it also makes US-China conflict more likely. Markets like certainty. This deal creates short-term certainty about investment flows, but long-term uncertainty about geopolitical stability. That's a trade-off. Here's what to watch over the next days and weeks. First, China's official response. Will they issue a formal protest, announce retaliatory measures, or stay quiet and plan behind the scenes? Second, TSMC and other companies announcing specific timelines for U.S. fab construction. The $250 billion is a commitment, but the devil is in the details. When do these fabs come online? What nodes are they producing? How many jobs? Third, additional U.S. moves. This deal doesn't exist in isolation. Expect more export controls, more restrictions on technology transfer to China, and possibly more tariffs on Chinese goods. The Biden administration started this strategy. The Trump administration is accelerating it, and it's bipartisan. Both parties agree on getting tough on China. This is the new normal. Now let's zoom out. What does this deal mean for the future of global trade? We are watching the end of globalization as we knew it. For 30 years, from the 1990s to the 2010s, the world operated on a simple principle: build and sell wherever it's most efficient. That created a deeply interconnected global economy. Goods, services, capital, and information flowed freely across borders. It made things cheaper and faster, but it also created dependencies. And when geopolitics turned hostile, those dependencies became vulnerabilities. We're now entering an era of what experts call friend-shoring or ally-shoring. Instead of one global market, we're splitting into competing economic blocs. The US and its allies, Europe, Japan, South Korea, Taiwan, Australia, form one bloc. China and its partners, Russia, Iran, parts of Southeast Asia and Africa, form another. Countries in the middle, India, Brazil, Indonesia, are trying to play both sides. And this trade deal is a perfect example of that shift. What does this mean practically? Higher costs and less efficiency. Building fabs in Arizona is more expensive than building them in Taiwan or China. Labor costs more. Regulations are stricter. Supply chains are longer. But the trade-off is resilience and control. If there's a conflict, the US doesn't lose access to chips. More resilience for those inside the bloc. If you're in the US allied camp, you get tariff relief, subsidies, and political support. But if you're outside, you face tariffs, sanctions, and exclusion. More vulnerability for countries in the middle. If you try to stay neutral, you risk getting squeezed by both sides. Imagine being a company that sells to both the US and China. Now you have to choose which standards to follow, which supply chains to use, which partners to trust. That's the new world. Fragmented, more expensive, less efficient, but more secure for those inside the walls. So here's where we are. The US and Taiwan just signed a deal that locks in Taiwan as a critical ally, moves $250 billion in semiconductor capacity to American soil, and directly challenges China's technological ambitions. In the short term, it's a win for US supply chain security and Taiwanese companies. In the medium term, it escalates US-China tensions and increases the risk of retaliation. And in the long term, it's another brick in the wall, dividing the world into competing economic and technological blocs. Now, I want to hear from you. Do you think this deal makes the US more secure or just more isolated? Will China retaliate, and if so, how? And if you were running a company caught between the US and China, what would you do? Drop your thoughts in the comments. This is economic warfare, and we cover this stuff every single day. Tariffs, sanctions, chip wars, currency battles, all of it. If you want to understand the real forces shaping markets and power, subscribe and hit that notification bell. Tomorrow, we're breaking down exactly how China might counter this move and what that means for your investments. This is just the beginning. I'll see you in the next one.